Ever wondered if 401k withdrawals before age 73 count toward your required minimum distributions, also known as RMDs? Did you know the government decides when you must start spending your 401k and IRA money in retirement? Welcome to Money Not Math number 156. Tune in to learn more about RMD Essentials, understand that taxes are only delayed, not avoided, strategies, discover ways to delay or avoid RMDs, retirement planning tips, get expert advice to secure your financial future. Don't miss out. Share this podcast with friends, comment with your questions and thoughts, like this post to help us reach more people, or contact me privately for a personalized retirement planning conversation. Disclaimer: this content is not legal, tax, or investment advice. Always consult a qualified professional for your personal situation. And even though I am legally licensed to give financial advice, if we haven't signed a contract, this is just information. It is not financial advice to you directly. So, like I said, reach out if you have questions or thoughts. For today's Money Not Math number 156 conversation, we will be reviewing an article from yahoofinance.com written by Mark Henricks, and it is titled, "Do 401k withdrawals before I turn 73 count toward my RMDs?" And this is a really important topic for anyone who is planning for retirement and a majority or at least some of their assets are in tax deferred accounts like 401ks or IRAs. Now, for a quick clarification, if your money is in Roth 401ks or Roth IRAs, that money is not tax deferred, so it's not a big deal. You've already paid your taxes. But if you're in 401ks, IRAs, SEP IRAs, things like that, you have deferred the tax and you will owe it one day. Therefore, the government gets to tell you when you have to start spending it if you wait too long. So let's dive into this article. If you have a tax-deferred retirement savings account, such as a 401k, taking earlier or larger withdrawals than required won't directly reduce future mandated distributions. However, since pulling money out now will likely reduce the future balance of your 401k, it could indirectly reduce the size of the compulsory distributions or forced distributions. That's because these obligatory withdrawals are calculated based on the amount of money in your tax-deferred account at the end of the year. In some situations, you can delay, reduce, or even eliminate the need to take RMDs using other approaches, including transferring retirement funds to a Roth account or using funds in your 401k to buy a special type of annuity. While the basic rules are laid out below, you should also consider speaking with a financial advisor about building the best retirement income strategy based on your specific circumstances. And I would agree with that. It is possible for you to figure this stuff out on your own. Absolutely not saying it's not. Many of my clients are likely smarter than I am. However, do you want to take the time, energy, and effort to do it on your own or lean on the experts that do it every single day? So if you have someone you already trust, please reach out to them, ask questions. If you don't, feel free to give me a call, shoot me a message, and we can schedule a time to chat and see if there's a way I can be of service to you. And if it's not me, I'm happy to point you in the direction of someone else that can. Moving on with the article, RMD Essentials. When you save money for retirement using a tax-deferred account such as a 401k, the taxes are only delayed, not avoided. In most cases, you will have to pay income taxes on the funds when you withdraw them. And rules about required minimum distributions, or RMDs, that necessitate regular withdrawals is starting at age 73, keep most savers from leaving the money in the account to grow tax-free indefinitely. And this is important because the average, I think I read the other day, the average person lives in retirement for 20 years. Also, for most people who are retiring today, their full retirement age is 67. So if the average person is going to live in retirement from the age 67 to 87, that means you only have, if your money is tax deferred in IRAs and 401ks, you only have complete control of your money and when you want to spend it from ages 67 to 73 or 6 years. The rest of your retirement, the government may come in and force you to spend more than you want to, or at least distribute more from your accounts than you want to. So it's important to have strategies to address it before it happens or when it happens to make sure you don't lose out on your money or at least spend it inefficiently. And especially if legacy is important to you, this is really important because they also made changes to how inherited IRAs work. Your inheritance or the people you leave money to, if it's tax deferred, only get 10 years to spend that money. Where if you leave it in other ways or in other types of accounts, they'll have more flexibility and less tax consequences. Continuing with the article, the RMD rules are explicit and strict. One clear restriction is that you cannot apply withdrawals taken before RMDs are required to directly reduce the amount of future RMDs. The same goes for withdrawals in excess of RMD amounts later on after RMDs have begun. Having said that, taking money out now or later in excess of the RMD amounts will help reduce the balance in the account that is subject to RMDs. Since RMD amounts are calculated as a percentage of the account balance, a lower balance will generally mean a lower RMD. Withdrawals are usually taxed as normal income no matter when they are taken, so it may make sense to take them now if you think you'll be in a higher income tax bracket after retirement. A financial advisor can help you plan and execute an RMD strategy. Additional RMD strategies. Some other ways to reduce, delay, or avoid taking RMDs could also help. For one, if you are still working after retirement, you may be able to delay RMDs. This only affects 401k plans, not IRAs. And it only applies to 401k plans that belong to the company you are working for when you would otherwise have to take RMDs. That is, you'll still have to take RMDs from 401k plans from previous employers. If you stop working, you'll need to take RMDs, and some plans may not allow this at all. So what they're saying is, if you have IRAs, you definitely have to follow required minimum distribution rules at age 73. If you have old 401ks from old companies, you definitely have to follow the rules. However, if you have a current 401k at a company that you're currently working at and you work past the age 73, you might be able to delay taking the RMDs if your company 401k allows it. Another approach that could help is to use funds in your 401k to purchase a special annuity. A qualified lifetime annuity contract, or QLAC, lets you defer RMDs until as late as age 85. The IRS limits the amount of tax-deferred money you can use to purchase a QLAC to $200,000 for 2024. Also, you have to pay taxes on future payments from the annuity, and you can only delay these payments until age 85. So going back to our example of if you retire at 67 and you live 20 years to 87, you have deferred this tax for most of your retirement. However, it will be due at some point either by you or your heirs. And it also may be inefficient to buy an annuity if it's only paying you for 2 years, if you hypothetically pass at 87. So continuing on, Roth conversions offer another potential solution. You can withdraw funds from your 401k or IRAs, paying taxes on the funds as regular income, then deposit them into a Roth IRA. Since Roth accounts are not subject to RMD rules, you will not have to take mandatory withdrawals from the new Roth IRA. Also, there are times where you can do a Roth conversion internally in your 401k. So I have seen it where some people's 401ks will allow them to keep their money in their 401k and transition it to a Roth 401k. So they pay the tax this year, but they never actually take it out and put it into an IRA. So that might be an option for you. Continuing on, the catch here is the prospect of a large current tax bill on the withdrawn funds. You may be able to mitigate this tax charge by only converting part of your 401k or by spreading the conversion out over several years. One approach is to set the annual or one-time conversion amounts so that they do not push you into a higher tax bracket. And that's typically the rule of thumb we like to use too, but there are certainly more factors to consider. You can use this free tool to match it with a fiduciary financial advisor to discuss your plans with a professional. So this article, like I said, is written by Yahoo Finance, and it even has a disclaimer right at the beginning that says Smart Asset and Yahoo Finance LLC may earn commission or revenue through links in the content below. So I think a lot of this information is valuable, but be aware that most of the links included are trying to sell you something, which isn't all bad if they're fiduciary financial advisor trying to give you advice, not just sell you a product. So coming back to the article, bottom line, taking withdrawals now will not directly reduce future RMD obligations. However, anything you do to reduce the balance in your 401k reduces the amount that will be used to figure your RMDs when you have to start paying them. This can make sense if you will be in a higher tax bracket after retirement. Or you don't want to leave tax deferred legacy assets. You can also reduce or avoid or delay taking RMDs until after the usual effective age of 73 by using 401k funds to buy special annuities, converting 401k funds to a Roth account that is not covered by RMD rules, or by continuing to work at the employer sponsoring your 401k. So that's everything regarding 401ks and RMDs. Here are some additional tips regarding financial planning and retirement planning specifically. Finding a financial advisor does not have to be hard. Here's a sale, right? They have a tool here. Smart Assets free tool matches you up with 3 financial advisors in your area. La da da da. Long story short, I encourage you to find someone you trust to ask questions. And if you don't have that person, I'd be more than happy to have a conversation. Or if you want to use Smart Assets, free warning, we have checked into their services before, and they basically just sell your information to multiple advisors who just all call you at the same time. And then you have to pick which one you want to talk to over the phone. So, not the greatest situation, but it's not terrible. It's better than not talking to anyone. They have another tool here that says estimate your tax bill or refund from your next return using Smart Assets Federal Income Tax Calculator. So this is one service we provide all of our fiduciary clients where we actually review your tax returns, analyze your current taxes and future tax projections, and try to build out the best strategy possible to be as efficient as possible around your overall your tax obligation. So it's taking into account, yes, how much you're going to owe in taxes this year, but also how much you're going to owe in taxes over your lifetime and how much you're going to leave in tax obligations to your legacy and heirs. Next tip, keep an emergency fund on hand in case you run into unexpected expenses. An emergency fund should be liquid in an account that is not at risk of significant fluctuation like the stock market. The trade-off is that the value of liquid cash can be eroded by inflation, but a high interest account allows you to earn compound interest. And then last but not least, they're just trying to do a sales tip to me. It's getting me to sign up to further smart asset services. So hopefully this conversation is helpful for you. Like I said, please reach out with questions or comments. And if you're really feeling kind today, I would genuinely appreciate it if you would share this on your social media page or directly with a friend. The more people I can provide good value to, the better. And or comment with questions or thoughts. And at the very least, click the little like button because the more people will like it, the more people Facebook and LinkedIn will show this to. So again, my goal is to provide as much value to as many good people as I possibly can. Thank you so much for your time. Time is the most valuable resource we have. I hope you have a wonderful day. It is January 27th, and at least here in Thief River Falls, Minnesota, it is absolutely beautiful outside. So thank you. I hope you can go and appreciate your day and have a wonderful week. Bye.